guest on Market Call today is Brian Madden, Chief Investment Officer at First Avenue Investment Counsel. He's taking your questions on North American stocks. You know that number, 1-855-326-6266, or you can email us, marketcall@bnnbloomberg.ca. Brian, thanks very much for joining us. We've got a falling interest rate environment. If we get more cuts this year, of course. What kind of strategy do you suggest at a time like this?
Yeah, so of course, I think what you're referring to, Andrew, is the Bank of Canada's quarter-point rate cut and the Fed matching a few hours later yesterday afternoon, both widely expected. So that, broadly speaking, is good for the valuation of all risky assets because, of course, risk-free rates are foundational to the cost of capital for companies. So lower interest rates, other things being equal, would tend to see a re-rating in stock prices and equity indices. We're seeing that follow through today. But really, our team, we manage two long-only North American mandates at First Avenue. They're focused, high-conviction portfolios, and as ever, we're trying to own best-of-breed companies, but really in two different veins. One mandate is looking for companies with a demonstrated history and capability of being able to grow their dividends, underpinned by a strong position and a competitive moat in the business. And the other, more aggressive mandate is looking for companies with very strong fundamental momentum, so sales, earnings, cash flow, and so on, and stock prices moving up and to the right. And we're finding them, but I will say, it's a two-speed economy, so the job market is not terribly healthy. We know in Canada we've seen two back-to-back months of job losses, unemployment rate at ex-COVID near 10-year highs, and U.S. job creation has been pretty tepid as well. And all that's to say, Andrew, the experience of the man and woman in the street or the median household in Canada and the U.S. is not all sunshine and roses, and yet we have corporate profits and equity indices within a hair's breadth or at all-time highs. So to capitalize on that, our portfolios to the main are invested predominantly in mid and especially large capitalization enterprises, which tend to have more resilience, more robust structural profitability, and crucially have a more global orientation than, let's say, the median household or median business in Canada or the United States. And it's working well.
Yeah, it's interesting. I mean, we do... We can be parochial. People obviously are interested in local news, what's happening in their own country, but it's such a world out there. Apparently, if you visit countries in Asia now, they have this glittering infrastructure that we're nowhere near building. I mean, they got a later start, I guess.
Well, but they have been fast followers. I myself spent some time on the ground in Southeast Asia last fall and was really pleasantly surprised, shocked even by the modernity of some of these cities that I had not expected. So, to that end, it's great that 40 or 45% of the S&P 500 profits come from overseas, and a significant portion of the Canadian equity market is very outward-looking in orientation as well, and, we're capitalizing on that.
Brian Madden is on Market Call today, Chief Investment Officer at First Avenue Investment Counsel. North American stocks are on the menu, and the number toll-free, 1-855-326-6266. We'll kick off with an email from Charles. Is Visa, do you still consider Visa a buy?
Thank you for the question, Charles. I should clarify, I'm often asked about this company. We do not ourselves own it, but each time I'm asked about it, I have to concede it's a great business that we'd have no qualms about buying. It's huge. That goes without saying, 4.5 billion cards in circulation around the planet in 200 countries. It's a $675 billion market cap business. And it's got a dominant position in what's effectively a tight oligopoly in payments. It's sort of split 40-60 between credit cards and debit cards. And those are both great businesses that are growing secularly. And it's also 40-60 in terms of domestic versus overseas business. We'd expect the earnings will continue to compound as they have for a long time at about a 12, 13, 14% pace over the coming several years. And crucially, because of the competitive moat and the incumbency that they have in the payment space, it's not particularly likely to be disrupted. It's often compared to its major rival, MasterCard. It trades at a bit of a discount to MasterCard right now. It's trading on about 27 times earnings, and that's roughly in line with where it has traded over the last 10 years or so. MasterCard is growing a little bit faster, probably more like a 15% growth rate. But again, it trades at a commensurately higher multiple, about 32 or 33 times earnings. So either one or both of these companies we'd be fine with buying and holding for the very long term. They're just sort of great wide moat businesses. And I would note that Visa has pulled back about 8% off of its recent highs at a time when the equity market is testing and making new all-time highs. So when you've got a compounder like this that's compounded at about 22, 23%, which just makes for a multi-bagger since its IPO in 2007, you buy the dip. So no concerns about buying this one.
But you said it's not a stock you own right now.
We do not own it, no.
Just valuation, or you can't own everything, I suppose?
That's it, yeah. So we run tight, focused portfolios of 30 stocks. And so in financials, we've got other ideas that we think are going to work out better. But, if we were to own more names, we'd certainly consider Visa or MasterCard for that matter.
Bob is calling from Toronto. Go ahead, Bob, please.
Yeah, hi, Andy. Hi, Brian. Brian, I always appreciate your detailed analysis of these stocks. I bought Nutrien a while back, and I'm making a little bit of money on it. But for the past little while, it's been sort of flat, and I'm just wondering if you think I should hold it or continue or sell it at this particular time.
Great. Thank you for the question, Bob. I would say we're largely in the same boat here. We had owned this years ago. Fortunately, cut it loose in late 2022, sensing the top of the fertilizer cycle. That proved to be a wise, prudent decision because the stock got basically cut in half. We re-entered the name in December or January. And it's grinding higher, but hasn't re-rated meaningfully. And what predicated our decision to re-enter the name was, we could sense there was a turning point in the fertilizer price cycle. And for the viewers, a reminder here, this is a company that is vertically integrated with 3 upstream commodity segments, notably potash mining and phosphate mining and nitrogen fertilizer production. And then the vertical integration comes with a network of farm supply stores, about 2,000 of them in Canada and the US and in South America, where they sell seed and fertilizer and financial services and whatnot to farmers. So the big swing factor for this company's earnings are potash prices. We think they have demonstrably turned the corner. There's been a bit of a fade in the last couple of weeks and months as some of the agricultural commodities that their customers produce have softened. So corn, wheat, soybeans, primarily in the US and other things elsewhere around the world. But we think patience will be rewarded here. This company is financially strong, improving margins in the downstream segment, and has expansion optionality in some of the upstream mining and fertilizer segments. So it's trading at about a mid-cycle valuation, yielding, I think, close to 4%. And we expect the dividend will grow steadily. So we see a good path to a double-digit total shareholder return through a cycle. But as you know, with commodities, when it comes, it can come on fast and suddenly. We've certainly seen that with gold. And we saw this with Nutrien, of course, as well in 2021 and 2022 when the commodity prices of what they produce went on a moonshot. So we're being patient here at Counsel to do the same.
We've got John calling from London, Ontario. Go ahead, John, please.
Thank you, Andrew. Hello, Brian. Thanks for all your great recommendations, such as Arista Networks. So think of data centers, weaving them together in a network. Earnings are growing about 20%, revenue about 20 to 30%, and they've had 4 consecutive positive surprises on earnings. Do you think Arista is doing what you expected? Thanks very much.
Yeah, thank you very much for the kind words, John, and for the question. And your kind words I'll pass on to my colleague Ian Chung, who leads the research file on this name. And I'll say we've owned this for 3+ years and have been very happy long-term shareholders of it. And we continue to own, and buy it. We're very encouraged by the latest earnings report and the guidance that came along with it. So yes, they are integral to stitching together data centers with routers and switches and all that connective tissue, to use a very non-technical term. And so it might be a little bit unsung and gets less of the glamour than the big semiconductor companies that make the GPUs and XPUs for AI compute, but nevertheless, these parts are integral to data centers and campus computes and other corporate environments. So we see a long runway of growth in front of them. And also, crucially, it should be noted, Arista has very much hitched their wagon to the big hyperscalers. So they're big customers of the likes of Meta and Amazon and Microsoft and so on. So as long as these companies are in this escalating arms race to outspend one another and build out data center and AI compute, Arista is going to come along for the ride, and we think the ride has got some time on the clock yet. So still long and strong, this one.
I think I remember reading quite a while ago that Arista is one of these companies that's just ubiquitous through the internet. Whatever you do, you're likely to come in contact with one of their services.
Yeah, exactly. So it's not a household name because it's not a consumer product, but on the back end of everything we do when we're querying or engaging with a data center, which we might not even perceive, there's ones and zeros and electrons and so on moving over their pipes. So it's all there. It's all part of the plumbing of the internet and increasingly the AI economy.
We're going to be back with Brian Madden of First Avenue Investment Counsel. The topic, North American equities. Aaron is calling from Thornhill, Ontario. Go ahead, please.
Oh, hi, Brian. Thank you for taking my call. My question is on MDA Space. As you know, they lost the contract with EchoStar, and the stock dropped 25%. Do you see this as an opportunity, and do you own it? And what do you think your 12-month target might be on MDA Space? Thank you so much, Brian. Bye-bye.
Thank you very much for the question, Aaron. I'll start by answering the second part of your question first. As I have done 100% of the time on this show over a decade plus, whenever asked for a target price, I do not offer one. We don't believe in target prices. They give sort of an illusion of certainty that frequently doesn't exist in the market. However, we do find this name intriguing. We like the fundamentals of the business. It piqued our curiosity after meeting with the management team at a broker-sponsored industrials conference in May. We wound up our summer intern on the research file on this name, Michael Ceramataro, who led that project very capably, overseen by some other members of my team. And so to sort of summarize, we very much like the fundamentals of the space economy, which this company sizes up as a $1.5 trillion addressable market. For context, they themselves have a $4.8 billion order backlog, although they did lose the EchoStar contract a few weeks ago. And we're sort of elbowed out, let's say, by SpaceX and Starlink, which, as viewers might know, is that other little company of Elon Musk's. And that was a result of EchoStar refocusing their business for tighter integration with Starlink. Nevertheless, this is a company with a good order book. It's underpinned by, top-tier customers like the Government of Canada, their biggest customer, Telesat, Globalstar/Apple, and then a coterie of defense contractors. So the opportunity here is they manufacture low Earth orbit satellites, and those are used in the telecom industry and increasingly in the defense applications. And obviously we know Canada and all the NATO allies are significantly upping their defense spending budget. So between that and the telecom opportunity, we think it's good. So we're watching, waiting, and sort of assessing what the balance of opportunity and risk is post the EchoStar contract loss. But I'd say we lean bullish on this name, but haven't quite pulled the trigger on it. But, stay tuned.
Let's squeeze in another caller because we're getting loads of calls for Brian today. Peter in Calgary, go ahead, please.
Good morning, gentlemen.
Hi there.
Brian, I like your opinion on Artis REIT, please.
Thank you very much. And they're going through that merger with a banking company that will turn them into a hybrid. There'll be a bank with a real estate portfolio.
Yeah, that's right. So thank you for the question, Peter. So this is not a company that we own. We have another REIT that we think has better prospects, but we did take note with some interest of this going private transaction, which the market seems to be giving a big thumbs down. It's pretty peculiar, the structure of it. It looks like it's probably largely a done deal unless there's some active shareholder dissent. To my eye, though, there's not sort of big blocks of institutional money in this name that could credibly block, what looks like a friendly approach from this RFA Capital. So just to summarize what's going on here, a private company is acquiring Artis REIT, so it's going to be delisted at basically zero premium, and the shares in this publicly traded liquid vehicle are going to be swapped for something that's unlisted for a period of time. And I think at some point down the road, they're going to relist the business.
I think they plan to relist pretty promptly, but I'm not 100% sure how that's going to work.
And neither are shareholders,
Okay, yeah,
so I think that may be why there's confusion here. But this is quite a small company, $300 or $400 or so million market cap, and that's probably why there's not a lot of institutional positioning in the name. So, I think this one, unfortunately, may be a bitter pill for, long-suffering shareholders to swallow. However, I would say, just sort of as a sectoral observation, it underpins a belief that we have long held, which is that the private market value of a lot of these publicly traded real estate investment trusts vastly exceeds their quoted share price. And that's why we have a position in another one. And we've certainly seen more than a trickle, but less than a gush of other REITs get delisted and taken private this year. So I think bargain hunters are smelling value. And this one, we'll see how it all plays out. But I think it is unfortunate for the public shareholders that there's not a premium and that the liquidity is going to go away. But I don't see much scope for a better or higher offer, frankly.
Okay. And I'm not 100%. We talked to the guy, the chairman yesterday on BNN Bloomberg, and then he's the CEO of this FCA bank that it's being merged with. And I forget what time scale he gave me, if there's going to be a delisting or if it'll roll over. But in any case, Scotia said this deal is hard to analyze.
It is a tricky one. It's a peculiar one. And so, for shareholders, it's sort of a case of trust me and hopefully there's value creation, or you sell now, take the money and, pick again.
Right, yeah. I should have said RFA Capital Holdings is the partner, RFA, sorry. Jacob is in Toronto. Go ahead, Jacob, please.
Hello, good afternoon, gentlemen, and thank you very much for the education that you're giving us about the stock market, to you, the anchorman, and your hosts. I appreciate very, very much and learn a lot, and thank you very much. As for my question, if I can ask your host, please, about Brookfield Corporation, if I should hold it or just sell it, and also if he has it in his portfolio. Thank you very much and have a great day.
Thank you very much for the question, Jacob, and for the kind words. We do own Brookfield Corporation in both of our equity mandates. We have owned it for a number of years. Continue to be very constructive on the business, the industry, the management, and the strategy. It's underpinned by Brookfield's leading position as one of the world's preeminent alternatives asset managers. Something that we know quite well ourselves, having an in-house private market alternatives capability at First Avenue Investment Counsel. And as many investors will know, funds flows and the growth of the private market alternatives world, and in Brookfield's case, that spans real estate, infrastructure, renewable energy, insurance, private equity, and so on and so forth. The allocations to those asset classes have been outgrowing and outstripping allocations to publicly traded stocks and bonds for decades now. It is a scale and scope advantage business. Brookfield has been doing this for 100 plus years in one form or another. They have boots on the ground, both the investment professionals and operating professionals on, I think, every continent. Over $1 trillion on their balance sheet, so ample financial strength via their funds and their own financial capacity to co-invest alongside their limited partners. And so, this is just a serial compounder and has been for a long time. Management has a lot of skin in the game, owning billions and billions of dollars of the stock. So we also like the shareholder management alignment. So, this is a very high conviction long-term holding for us. So comfortable buying and continuing to own it here.
We'll check out Brian's past picks next. He did pretty well on a big Canadian bank and a gold producer. Brian was on our show September 26th of last year. His first idea was Allied Properties REIT. This one has bounced off its lows and a return of 12%.
Yeah, we bought this about 13 months ago, Andrew, and I'll say, we're not in this business to scratch an intellectual itch or to be contrarian just for the sake of being contrarian. And so in the main, most of our holdings are not contrarian ideas. This one was, though. So as viewers may know, this is a company with about 13.5 million square feet of space, mostly office, some retail, predominantly in Montreal and Toronto. They're renowned for revitalizing the King Street and Front Street corridors. They built the Well, the largest urban revitalization project in Canada, about 3 million square feet a few years ago, with partners. And this stock was down in the dumps. It was consensus short or avoid, speculation about them cutting the distribution, which is a meaty 15 cents a month, is yielding about 10%. And our sort of conservative prognosis was they'd keep paying the distribution and that would pay us 10%. We got a bit of icing on the cake. It's re-rated higher. We think there's more in the tank. Occupancy stabilized. They're selling non-core assets. They're deleveraging, they're leasing up some of their development properties and just kind of cleaning up the picture. And all this amidst what is a renewed push to return to the office, which should drive occupancy higher. And the size of the prize is large here, even with this having bounced off its lows, it's still trading at less than half its book value. If there were a takeout scenario, precedent transactions have been at 0.6 or 0.7 times book value, so there could be much, much more upside here. So we continue to like and own this one.
Okay, your next idea was Newmont, and of course, gold stocks have been fun to own over the past year.
Yes, we don't own this one anymore, so we may, I suppose you could say glass half empty, glass half full. Perhaps we got off the ride a little bit too early. We sold it in February at a lower price. However, that was not predicated on any negative outlook for the company or for gold, which of course has gone much, much higher, but rather to increase our torque or leverage to a rising commodity price. So we rotated out of this one into an intermediate producer. And so that new investment is paying off rather nicely as well. But Newmont, I will just say for the avoidance of doubt, we continue to be very bullish on gold. It's an enigmatic commodity or currency, depending on how you look at it. But the tail of the tape is it is in an unambiguous and unalloyed bull market. So we continue to have meaningful exposure to the sector, just not Newmont.
And finally, TD Bank, another recovery story.
Yeah, so this one I wouldn't describe in quite as strong a terms as I did for Allied. It wasn't necessarily contrarian, but it did have a bit of hair on it, let's say, to be polite, this time a year ago. And it was trading at a severely depressed multiple relative to all of the other banks. And so, I've often said when asked about it, which happens often, it was tarnished, but not irreparably so. And so they took steps to settle their dispute with the Department of Justice, paying an epic fine. They changed out the CEO. They've changed out a lot of the management team. I will be attending their upcoming Investor Day here in Toronto on September 29th, where we'll hear more from their newly installed CEO, Raymond Chun, about the go-forward strategy. And so, we think this is a turnaround story that's partially back to regaining its old luster, but we continue to see good prospects in front of it. And as a reminder, the algorithm for us for this and the other Canadian banks we own is, you get the dividend yield, that's 3%, 4%, 5%, depending on when you buy it. And most of the Canadian banks aspire to and succeed at growing their dividends at a high single-digit pace. you put the two together, and generally speaking, over a cycle, you get a low double-digit total shareholder return. And we continue to believe that TD will be able to do that. So we still own, I like this one.
We're going to be back with Brian Madden of First Avenue Investment Counsel, taking your questions on North American equities. We have Wade on the line from Ottawa. Go ahead, Wade, please.
Thank you very much for taking my call. I would like Brian's opinion on Fairfax Financial. It seems to have been consolidating a little bit. Just wondering what his opinion is on the company itself. Thank you.
Thanks.
Thanks for the question, Wade. We own this in our momentum mandate, added to the portfolio in, I think, late 2022. Continue to be encouraged by what the company is doing. Quick reminder, it's a property and casualty insurer and reinsurer with North American, global, and international insurance subsidiaries. The name itself is mnemonic, which stands for Fair Friendly Acquisitions. So they're a serial acquirer and consolidator of the fragmented insurance underwriting business. And then the other side of the business is investing the float, which now is running upwards of, I think, $60 billion. Prem Watsa is sometimes described as Canada's Warren Buffett. But they invest mostly in bonds, so the higher interest rate environment has advantaged the investment income. But they also take meaningful stakes in public and private equities and have been quite active on that front, adding lots of interesting bits and pieces to the portfolio and supporting a new and higher level of run rate investment income going forward. It's not a demanding valuation, trading at sort of low double-digit price earnings multiple, maybe 30 or 40% premium to book value. Pays a modest dividend, but not as high as the other insurers because they want to keep and grow and compound their capital either in their portfolio or by acquiring other insurers. And we applaud what they're doing and continue to like and own the shares there.
Okay, thanks very much for that question. We've got Frida on the line from Chilliwack, BC. Go ahead, Frida, please.
Hi there. I'm interested in your outlook for Shopify as it zoomed up today. Please give your outlook. Thank you.
Thanks a million.
Thanks for the question, Frida. We also own Shopify in our momentum mandate. One of the biggest companies in Canada, briefly surpassed the Royal Bank as the largest company in Canada. I don't know, might be on the cusp of doing that again. But obviously an e-commerce giant with sort of e-commerce in a box enablement for small and medium-sized businesses historically, but increasingly they're turning to enterprise customers. And then their ancillary services, so payments and shipping and that sort of thing are bolstering their take rate or the percentage they take from all the gross merchandise value transacted over their platform. And we still think there's lots of room in the rise of e-commerce adoption. It's more mature in the US, less so in Canada, and of course they're expanding into other jurisdictions and geographies. So we think there's a long runway of growth in front of them. It is expensive, it's always expensive, but great companies that are disruptive icons that define a whole new segment almost always are. So that does not deter us one bit. So we continue to have a good weighting in Shopify shares.
Okay, thanks very much for that question. Paul is in Prince George, BC. Fire ahead, Paul, please.
Thanks so much for taking my call. I know one of the rules of investing is never fall in love with a stock. Sometimes that's a little harder to achieve after you've had success. But I own CGI at about $34, and lately it's not in a happy place. I don't know if it's AI or I've heard there's problems with potential problems with their U.S. contracts. So words of wisdom, please, Brian.
Thank you for the question, Paul. We don't own CGI, certainly know it well. I've owned it in the past. It's systems integration and business process outsourcing. You're right to point to their exposure to the U.S. government, both federal, that's civil and military, and also state and local governments. That's an area where they've been expanding. This is another serial acquirer, and lately, last few years, their strategy has been what they call metro market tuck-ins. And remember, this is sort of a nearshoring play recently where, although they have an offshore service delivery center in India, I think one of the reasons they've been successful in getting these contracts with state, local, and federal governments is because they do create jobs for Americans. And the U.S. governments collectively are their largest customer. So, some of this dodgy Musk belt tightening might have sort of upset the apple cart there. And also, let's not forget, their home country is Canada. They do business with the federal government. They do a lot of business with our banks. So Mark Carney is increasingly talking about procurement efficiency and belt tightening at the federal level. So all that may be causing some consternation. And finally, I think you hit the nail on the head when you mentioned AI. There's a lot of sizzle in the market. This is sort of more of a steak. It's an old tech business. It's nuts and bolts, and it's not as sexy as some of the emerging new areas. So I think to some degree, the recent weakness, maybe just money flow going into some of the sexier, sizzlier names. So, we'd be on the sidelines and watching and seeing how this all plays out for now. But you can't argue with what this company has done over decades. It has been a good grower and compounder, but it's not tempting us to put fresh money to work right now.
Let's squeeze in an email. Galen is asking, what are your thoughts on Carnival?
Yeah, thank you for the question, Carnival. This is the second largest cruise line operator in the United States. We don't own it. We wouldn't buy it. And I think maybe we're at odds with the mainstream. Everybody's got this FOMO and you only live once kind of mentality and revenge spending and all that stuff. We think that's mostly played out. The economy is weakening. Job market's weakening, macro uncertainty is weighing on households, albeit not the top 1% or top 10%, but that is not the target market for this particular cruise line. It's got a very high beta or market sensitivity. It's about 1.5. It's extraordinarily leveraged with $40 billion of debt. It's junk rated, BB. And the stock is back to, it's still 50% off of its all-time highs reached pre-COVID. Obviously, COVID created an existential crisis for them and the whole travel and cruise industry. The problem is their debt ballooned 3- or 4-fold during COVID. And their share count also doubled as they needed to do distress equity financing. So you look at it now, and it's about a $67 or so billion enterprise value. So that's 10% above the prior high water mark pre-COVID. So you might look at the stock and say, well, if it just gets back to its old all-time highs, it could double. Well, yes, except for they doubled the share count and diluted the value of the remaining shares. So we think this one is too richly valued and too risky for our appetite, so we would not buy it.
Okay, you're not sold on that one. We will be back with Brian Madden of First Avenue Investment Counsel, taking your questions on North American stocks. We're back, and we got Gary calling from Stony Creek, Ontario. Fire ahead, Gary, please.
Hi, Brian. Thanks for taking my call. My question is about Teck Resources. We purchased this stock back in July of 24. As you know, it's gone down markedly since then, and it doesn't appear likely that the merger with Anglo is going to go through. So I'm just wondering your recommendation. Should I hold or consider selling? Thanks, and I wait your response.
I don't know if he's overstating it there, but as you know, Scotia has said the Teck shareholders may reject this no premium takeover.
Yeah, so this is a very interesting story and certainly one of national interest, all the way up to the Prime Minister's office, Gary. Thank you for the question. We don't own Teck Resources, noting that it is a much better company than prior generations of it, hived off the coal assets, lowering the ESG footprint and becoming more focused on base metals, or some have now taken to calling them critical minerals, QB2, Cabrera-2, and Kalahari, and various other world-class copper mines are sort of the crown jewels. Anglo has quite rightly recognized that and is trying to sell this deal to shareholders. They've already sold it to the most important one, which is the founder, or the son of the founder, Norman Keevil, who owns the multi-voting shares, or most of them. But I think there's another chapter to be written to this story. It is a friendly deal, but there could be an interloper for either AngloGold or Teck Resources. I think potentially they're both in play. So, we don't own it. We probably wouldn't buy it here. But since you do own it, I think it's worthwhile holding on to for that optionality. Something's going to happen here, and it's probably not going to be the bottom falls out of the stock. I think the risk is lopsided to the upside here.
The political maneuvering would be interesting if the merged company has its headquarters in Vancouver but is incorporated in Britain. I wonder will Ottawa buy into that? Yeah,
I mean, it's a bit of a whitewashing of the whole thing, frankly. Obviously, we can see the substance of what's going on here. Predominantly the shareholders of AngloGold are going to control this company. You can say the headquarters is in Vancouver, but if the primary listing's on the LSE, the incorporation's there, where's the mind and management? So, we need to hear more about that. But also, I think more importantly, there could be a higher offer for Teck, or somebody could put Anglo in place. So, lots to be said still here, we think.
Neil is calling from Brampton, Ontario. Go ahead, please.
Yes, sir. Nice to hear, Brian. My question is on Canadian and the U.S. banks, especially in this declining interest rate environment. I'm betting very big on the Canadian banks. Please provide your opinion. Thank you.
Thank you, Anil. We like the Canadian banks. I've said that for as long as I've been coming on this show, which is a decade plus. We have about 10% of our dividend growers mandate invested in Canadian banks. We also own JP Morgan Chase. Banks are a leverage play on the economic growth of the regions in which they operate by lending to households and businesses. Admittedly, economic growth has been tepid and lackluster. In fact, we printed a negative GDP here in Canada in the second quarter, but the market is forward-looking. The bank share prices are reflecting that we're likely to see some reacceleration in the economy. The rate cuts that the Bank of Canada started earlier and was more aggressive on set that in motion and added fuel to the fire yesterday with another cut. Same thing in the U.S. with the Fed. Moreover, we're really encouraged by fiscal policy developments and policy developments in general, particularly taking note of the major projects office that the federal government set up. It's a great fanfare a couple of weeks ago, and then announced some pretty big ticket projects. So, what's going to happen here? We're going to cut red tape, and we're going to build things, and we really haven't done that in the way that we should for almost a decade now. So this is a game changer. And of course, who's going to lend to the project developers, whether it's all private capital or public-private sector partnerships? These are projects that are going to be debt financed, which should be growth positive for the bank's lending book. So we like the banks, and noting particularly Canadian banks run in a stable, well-regulated, well-governed, well-managed, tight oligopoly where 6 of them have effectively 90% of the market. And it's a must-have, not a nice-to-have, for a household or a business. So long and strong, the Canadian banks.
Brian, we just saw charts there for EQB and Laurentian. Can you remind me, what did you say about them, or what would your take be on those smaller players?
So EQB is intriguing. Obviously, they've had tragically some turnover in their C-suite. Laurentian Bank, different story. This bank's broken structurally, has been fading into irrelevance for 3 or 4 decades now. Yes, we know there were some rumors floated last weekend that someone might want to acquire them. I asked the open question, why would a larger player want to acquire them when they could just bleed them out by out-competing them? Because that's what they've been doing for 4 decades. But who knows? That could be a wild card. Maybe someone does want to take a run at it. It's a small, bite-sized deal for any of the big banks. I wouldn't be particularly happy to see any of the banks we own taking out Laurentian. So generally, we prefer the larger banks because banking's a scale advantage business, and Laurentian and EQ just don't have that same kind of scale.
Okay, and squeeze in a caller. William in London, Ontario. Fire ahead, please.
Afternoon. Thank you for your past suggestions. What's your opinion on increasing my holdings in Broadcom?
Yeah, thank you for the question, William. It's a difficult question to answer, and I take the responsibility of giving counsel to callers pretty seriously without knowing what the existing size of your holding is and what your risk appetite is. I will tell you that portfolio construction and portfolio risk management is paramount for us. So we do own Broadcom. My colleague Ethan Cummings has led a great research effort on this, and we put it into our dividend growers mandate about a year and a half ago. We did increase our position from, I think, 2 to 2.5 or 3% earlier this year. We've been well rewarded by that decision. But now it's sort of at the single stock risk concentration limit for a company with idiosyncratic risk like this one. So as much as we think the opportunity in front of them is fantastic, making semiconductors increasingly powering AI and data center compute, you don't want to go all in on something and then have an undiversified portfolio. So, just keep that in mind when you think about increasing your position size. I'm sorry if that sounds like a hedged answer, but I think prudence is important in portfolio management.
Don't go away. Brian will share his top picks after the break. Join us tomorrow on Market Call. Our guest is Peter Hodgson of I2I Capital Management, always insightful. He's going to talk about North American small and mid caps. And if you miss Market Call, as if that could ever happen, you've got our daily podcast, and there are some of the locations you'll get us: iHeartRadio, Apple, Amazon Music, or Spotify. Let's get to the top picks from Brian Madden. I'm intrigued by this one, Constellation Software. It's been a great growth story, but it is well down from its highs.
Yeah, and that's the beauty of it, Andrew. So for those who don't know, this is a fairly large but notoriously tight-lipped and inconspicuous software holding company. And what they do is they acquire vertical market software companies. So these are applications niche to a particular industry, like a daycare or a dog kennel or a golf course or something like that, and they're mission critical. And they enable them with best practices, shared services, and procurement. But generally speaking, they're acquiring from mom and pops and founders, and they let them continue to run the business and make decentralized decisions. So it's a comfortable landing for a lot of these founder types rather than the slash and burn MO of a private equity firm. As you said, it's been a great compounder. The IPO was in 2006. The shares are up 32,000% since then, notwithstanding that it is recently about 20% off of its highs. Very rare occurrence for this company. As I said earlier, they're notoriously tight-lipped and non-communicative. They report after the close on Fridays, which no one does. Don't hold conference calls, but they are hosting a conference call September 22nd to address AI risks and opportunities across their businesses.
Monday. I believe it's Monday. Yep.
That's right. So, this could be a catalyst and some much sought after further disclosure and detail from the company. So, we think in general, we've owned this for a long time, but 2 decades of history show us that pullbacks are always and everywhere viable in this name. So, that's what we'd be doing here.
They say a major shareholder wanted a question and answer session on AI and the impact. And they said, well, we'll share this with all our shareholders.
Yeah, which is great in terms of a disclosure practice, So, let's all learn about it.
We're tight for time. I'm sorry. KKR, what's the attraction, Brian?
So, as we talked about earlier, the Major Projects Office, this is a company that could be a poster child beneficiary as some of these private-public sector partnerships get unlocked in Canada. Of course, the playing field is much wider. KKR is a global leading asset manager, strong in private market alternatives. They IPO'd in 2010. They've grown their assets under management at an 18% compound pace to just under $700 billion now. So they get recurring management fee revenue from that, plus carry, or a share of the profits on the portfolios they manage on behalf of their LPs. They also, in 2024, acquired Global Atlantic, an annuity and insurance company, to smooth out some of the volatility of those private markets businesses. And they also have a large and growing capital markets advisory practice. This stock is also about 8 or 10% off of its January highs, despite the S&P 500 being at all-time highs. So we think a catch-up trade is very likely here for this company, which is up 2,300% since its IPO 15 years ago.
And we'll close out with Telus, the telecom giant.
Right. We think this is the best telco in Canada. It's yielding about 7.6%. That's very elevated relative to its 10-year average yield of 5%. We think not only is the dividend sustainable, we also think it will grow faster than the other Canadian telcos. A conviction underpinned by their decisions to increase the dividend 7% over the last year. The shares are perking up. We think that's in part due to the price war between the three big telcos that started about 2 years ago, starting to fizzle out, prices stabilizing, so they should all face easier earnings comps. Telus, again, we think has got more financial strength and optionality than its other telco peers and is less distracted trying to integrate recent acquisitions than the other big telcos. And finally, Telus, we think, has some unpriced optionality via, for instance, plans to monetize $3 billion of surplus urban real estate via redevelopment into high-rise multi-unit residential. So lots of ways to win here, and a fairly conservative need versus want type of a business. We think the shares should re-rate higher in the coming year.
Brian, thank you very much indeed.
Pleasure.
Brian Madden, our guest on Market Call, thanks very much for tuning in. Remember, we've got Peter Hudson coming up tomorrow.